There have been major agricultural support laws for over 80 years. The very first Farm Bill, the Agricultural Adjustment Act, was signed in 1933. These bills come up for review every 5 to 7 years. As you can imagine, the focus of farm policy has shifted sharply over the last 3 decades. In the 1990s and before, farm policy focused on controlling the quantity of the agricultural commodities produced. This was done through land retirement and fallowing programs, often under the label of soil health or conservation objectives. This included the Land Bank, the Conservation Reserve Program, the Wetland Reserve Program, and programs designed to maintain minimum market prices by effectively paying farmers not to produce beyond benchmarks. These programs were heavily criticized for violating free market principles and manipulating international trade. In the 2000s, the focus changed. A greater interest in compliance with international trade agreements resulted in the creation of programs that paid farmers specific designated sums. These sums were determined by base acres of land historically planted to various eligible commodities, with the amount of payment determined based on the historical yields for those commodities. These payments were decoupled from any actual production. This allowed farmers to respond to the market rather than farm programs when making planting decisions. These programs were also heavily criticized for their extremely high costs and for paying farmers even when there was no need. In fact, the 2008 Farm Bill was vetoed by President Bush, and Congress had to override the veto to fund these programs. In recent years, the focus of farm policy has shifted again. It now looks to form a modern safety net that provides support for farmers when they need it and does not make payments when farmers have no losses. This approach removes the need for widely unpopular and politically weak disaster programs and replaces them with predictable and consistently applied programs. There are 2 major components to this approach: farm programs administered by the Farm Service Agency, FSA, and federal crop insurance. FSA programs are administered at no cost to the grower and offer payments based on prices falling below established benchmarks or revenues falling below recent year averages for a limited number of eligible crops. Federal crop insurance, on the other hand, offers coverage for farmer yield or revenue losses for nearly every crop. Farmers pay subsidized but substantial premiums for this coverage, which is administered through a public or private partnership between the Risk Management Agency, which regulates the program, and individual private companies and agents who efficiently deliver the program to farmers.